Welcome to The Man from Macro, where we look at some of the big themes in today's global markets. This week, we're going to take a look at gold, which has recently been pressing its all-time highs. This is the fourth attempt at these levels, and this has happened at a time when investors have become less enthusiastic about the metal and downright hostile to the companies that pull the stuff out of the ground. Yet despite this sentiment, gold has done remarkably well, especially when compared to real yields. As you can see on this chart, gold has had a relatively good long-term relationship with US real yields. Here, real yields have been inverted to emphasize the relationship. But in short, gold goes up when real yields go down, and gold goes down when real yields go up. That's because rising real yields make bonds a relatively more attractive investment, and if bonds have a low or negative real yield, gold, which has no yield, is the one that becomes relatively more attractive. Remember, real yields are inverted here. But what is also remarkable is how well gold has performed despite real yields having risen over the last couple of years. Based off the old relationship, gold should probably be closer to $1,000 today. So gold has weathered a storm of rising yields and a period of relative dollar strength, which is often another headwind for commodities in general. And this is why some people are now getting excited. Yields in the dollar have been dropping. Additionally, expectations for a recession during which yields could drop further have been increasing. Even the much maligned gold miners have had a moment in the sun. The gold miners ETF, the GDX, has gained about 4% in the last few days, breaking the neckline of a reverse head and shoulders formation, which implies 35 as a target. But, as you can see with the high-octane junior gold miners, the GDXJ, these stocks are still in the long-term doldrums. Some people think that these stocks are doomed to disappoint. Others think that a break to new highs in gold could see these high beta plays finally start to provide some long overdue performance. So, will there now be sufficient concern about a recession and rising expectations for a policy U-turn by the Fed for yields to fall further? It matters because gold loves the support of loose monetary and fiscal policy, but will it break the highs of around 2075? It could be fourth time lucky. And if you want to reach for an even more volatile play, you could look at silver and its associated mining stocks, which have also been on the move. Silver, however, has still not broken its own long-term downtrend. There's still a lot to play for. Additionally, for people who do like the shiny stuff but still think it's too early, implied volatility is relatively subdued, so that investors can express views via the options market, where the losses can be limited to the option premium. And of course, just one more reminder, none of this is investment advice. These are just observations for educational purposes only, and everyone should be aware of their own investment objectives and risk profiles. Thanks for watching.